Okay, folks, it's 11 o'clock. Make sure. Are there any questions before we start? Because there's a reminder that I want to put out today, in case you haven't been checking your calendar. You know what's coming a week from today? You haven't been checking your calendar, have you?
Quiz?
Your first quiz is a week from today. Obviously, it is going to be online. And it's not going to be during class time. It's going to be accessible for about 10 hours that day, from 4 a.m. New York time to about 2 p.m. New York time. The reason I've opened the window up that much is there are people in different time zones. It's not fair for them to wake up in the middle of the night and take the quiz. So you can take it any time during that 10-hour period. The only thing is make sure that when you open the quiz that you have an hour to take it. You can't come back and finish it 2 hours later. So make sure you have an open hour somewhere between 4 a.m. and 2 p.m. on the 3rd, because that's when, and the quiz will cover everything we do through Monday, which will be discount rates, cash flows, etc. Right? And today, actually, we're going to get into cash flows. Any general questions about? Oh, one more thing. I'm going to send you an email with past quizzes, links, a review session. But there's one thing that's different about this quiz. My past quizzes, obviously, I gave in a classroom. I hate multiple choice questions. So my quizzes are open-ended. They're partial credit. I can't do that online. It's very, very messy on a big class to do open-ended questions and have the number, I've tried, it doesn't work. So this quiz is going to be multiple choice, but it's going to be built on the same kinds of questions that the old quizzes were. So if you read the questions, they're open-ended. I've just figured out a way to make them multiple choice. And that's good news and bad news. The good news is that the right answer is right there. You can see it's one of the 5. The bad news is there are 4 wrong answers. You have five choices. And if you make a mistake, a math error, then you might not get to one of those answers, but get to the right answer. And there's no partial credit. I can't figure out a way to give partial credit on it. So it's all or nothing. I've tried to alleviate that a little bit by breaking the questions down into, it's a 10% quiz. So basically that no question has monumental effect. So there's no 5-point question. So that's next Wednesday, sometime during the day, take the quiz. And because it's multiple choice, the minute when you finish the quiz, as soon as everybody's, the quiz shuts down, you should be able to check your grades almost instantaneously because it gets recorded. So there are no questions. We're going to pick up where we left off on Wednesday.
Professor, no change to how long the class is next Wednesday?
Do you want me to change it? I'd like to stick with the length of the class. So, I might, let me put it this way. I'll go an hour, not an hour and 20 minutes. I don't want to give up too much of the class because in a regular class, I'd have had a 30-minute quiz, 50 minutes of session. So we'll do an hour-long class rather than an hour and 20 minutes. Because the quiz will actually close before the class actually starts. So you shouldn't be taking the quiz while the class, so I'm going to try to create enough time so that you can take it at a time that works for you. Okay, so let's start with today's class. No other questions? Let's start with talking about cash flows. Today we're going to finish off discount rates, cost of debt, cost of capital, and then we're going to turn to cash flows. And one of the things we're going to talk about, what happened here? And one of the things we're going to talk about is actually earnings. And to get cash flows, you have to start with earnings, and you need the most updated number you can. Now, some of you might be lucky. Your company might have just come out with its 10K or its annual report. You've got the number fresh off the box. But for some of you, this is going to be a challenge, right? Either because your company has a year end in September of the year or June of the year. So the question is, how do you come up with the most updated earnings you can? And I'll give you some choices, and I want you to think about which of these choices makes the most sense. You could use the earnings report in the most recent 10K, which for some of you would be 2020, but for some of you that might be 2019. Your company hasn't come out with the 10K. You can take the last quarter's earnings number and multiply by 4. After all, it's the most updated, the most recent quarter. You can add together the earnings over the last 4 quarters. That's called a trailing 12-month. Or you can take the earnings to year to date. So if you have 6 months of earnings, take those 6 months and then take the projected earnings for the next 6 months based on analyst estimates or something else. Last 10K, last 10Q times 4, last 4 quarters of earnings, or taking this kind of consolidated 6 months of data plus 6 months of forecast. Which of these should be a non-starter that you're going to take right off the top? Bucky, why don't you start? Tell me which of these 4 should not even be a choice.
B, if it's a seasonal or cyclical business.
Because you have anything can happen in a quarter, right? So we can never multiply by 4. The real choice is between trailing 12-month data and this kind of melded historical plus forecast. Right? I'll use a lot of trailing 12-month data. The reason I don't want to use an analyst forecast for 6 months and complete it is then I've turned over some of my valuation to somebody else. I have no control over that. We're going to use a lot of trailing 12-month stuff. In fact, you can never complain that data is data, but even when you use trailing 12 months, some data is going to be more updated than others, right? Your T-bond rate will be as of today. Your trailing 12-month data will be as of the end of the last quarter, which might be December 31st. Don't try to be time consistent. You know what I mean by that? Don't say, look, my trailing 12 months ended on December 31st. I'm going to go look up the risk-free rate on December 31st. That's pointless because you want to make a decision today. And the way to think about this is the most updated number you can get for this particular item. So go down the list and for every item, look for the most updated number you can find. So we're going to talk a lot about earnings. We're also going to talk about capital expenditures. Now, in accounting, capital expenditures is what you invest in assets that have benefits over many years. Land, building, equipment, classic. So if you've been in an accounting class, the way it's described is you build a factory, it's capital expenditure. You pay wages to employees, it's an operating expense. So I'm going to list out some items and you tell me based on the definition of capital expenditure being expenditure designed to create benefits over many years, which of these items, if any, should be treated as a CapEx? And there can be more than one right answer. Building a plant, obviously, right? That's an easy one. That accountants would agree that's a CapEx. What about R&D? Jonathan, you're nodding your head. Do you think R&D meets the criteria for CapEx?
It can depend on the industry.
When you say depend on the industry, tell me more. What kind of industry would R&D be a CapEx and what type of industry would R&D not be a CapEx?
I suppose if you're in a industry where it's very heavy on innovation and development, R&D becomes increasingly important for.
Is it innovation and development that's a dividing line, or how long you have to wait for R&D to become a commercial product?
Say that again?
Let's say, is it innovation that is going to be the dividing line, or how long you have to wait to see benefits? Because if CapEx is benefits over many periods, a pharmaceutical company does R&D, it's not going to get the benefit this year. If it's lucky, maybe 6, 7, 8 years from now. Whereas a technology company, your R&D might very quickly turn into products, and that R&D might wear out by the end of the year. You got to do fresh R&D. If your R&D is the kind of R&D where the turnaround is quick and it very quickly wears off, it's like an operating expense. But if your R&D is R&D like a pharmaceutical company, clearly this is not even a question. I've never understood why accountants even make this an issue. Of course it's a CapEx, it's super CapEx. It's something we'll have to deal with because what do accountants do? They expense R&D around the world barring a few exceptions. If you do R&D, the expensive, I'll give you the rationale accountants use is completely, it doesn't stand up, but we'll talk about why our accounting does what it does, but it makes no sense. What about advertising by a consumer product company? Prachi, do you think that could meet the tests for a CapEx?
An advertising company,
Not an advertising company, advertising by a consumer product company like Coca-Cola or Kraft Heinz.
Got it. I don't know. Intuitively, I feel it should go under SG&A, under like marketing and advertising expenses, but
Okay,
I would not capitalize it.
Okay, let me ask you a follow-up question. What's Coca-Cola's biggest asset?
Advertising.
It's brand name, right? I mean, let's face it, it's not the taste, it's not the drink, it's brand name. And at least you can argue that some of that advertising that you see for Coca-Cola has nothing to do. Some of it is directed to make you buy more Coca-Cola this year. But some of it is designed to build that brand name, right?
But because brand name is like brand name or even IP or patents and those kind of things, how would you decide what part of advertising is like?
That's a good question. That we can argue, but let's face it, some advertising is really. So what I'm saying again, accountants expense. What if you're looking at recruiting and training expenses? By now you're getting a pattern of where I'm going. By an investment bank or a consulting firm. What do you think about those expenses, Stephanie? What do you think? Again, use the same thing I did for Coca-Cola. What's a consulting firm's biggest asset?
The employees.
Human capital. What I'm trying to say is accounting as we know it is this very rigid view of CapEx. If I can't see it, if it's not physical, if it's not a factory, it's not CapEx. And that might have worked 50 years ago when companies were primarily manufacturing companies. Look at the biggest companies in terms of market cap today in the market today. They derive their value from things you cannot see, and accounting does a terrible job of treating those expenses. In fact, I should put one more item. Now, if you're a company like Netflix or Uber, you spend a lot of money acquiring customers, customer acquisition costs, right? And this is your biggest asset, this big platform you built. It's a challenge now. When you value an Airbnb, those expenses you see as part of SG&A, some of it is CapEx. And we should be treating it as CapEx because we don't think of what happens. We misstate earnings because earnings will be this big negative number. We miss their biggest assets. They don't show up on the balance sheet. We get absolutely nonsensical looking values when we do cash flows because the accounting is screwed up. I'm laying the foundations for something we have to do with every company. We can't take accountants at their word because they have no idea what they're talking about. We actually have to take the financial statement of the company and redo it. Thank God it's not that difficult to do once you've made the choice, but it's something that I'm going to push you on when you look at a company. Don't take the accounting earnings, the accounting book value as the end games. Think of it as a starting game and think of how you'd adjust it, reflecting where this company gets its value. So now let's turn back to where we were on Wednesday. So I know I've thrown a lot of things at you. We'll come back and talk about the mechanics of converting R&D into a capital expense, the mechanics of capitalizing customer acquisition costs. But this is something we have to get so comfortable doing because almost every company we're looking at, this is going to become a core issue in valuing the company. So you remember on Wednesday, I laid out the basis, on Monday, I laid out the basis for the cost of debt. I said the cost of debt is the rate at which you can borrow money long-term today. Let me repeat that again. Rate at which I can borrow money long-term today. So basically, to get to a cost of debt, I'm going to start with the risk-free rate, long-term risk-free rate, and on top of that, add a default spread. So the entire process of estimating cost of debt becomes, how do I come up with that default spread? Now let's take the simplest way you could do it. You could go to Bloomberg, find a bond issued by a company, look up the yield to maturity in the bond, and say that's my cost of debt. The problem with that is risky companies can issue safe bonds. All they need to do is carve out their safest assets, issue a bond. And this is why ratings agencies have rating when they rate companies and they rate bonds separately. You can have a triple B rated company issuing a single A rated bond because of the way the bond is structured. It's very dangerous to base cost of debt on a single bond because yield to maturity in that bond reflects how that bond was structured. But thank God, if you issue a bond, you almost always have a company-wide rating. That company-wide rating should measure default risk if you trust ratings agencies. Big if, but if you do, then you can use the rating to come up with the default spread. Because you tell me I'm triple B rated, I can come up with the default spread. But I also said 90% of companies out there will have neither bonds nor ratings. They'll still have bank debt. You have to attach a cost to debt. I'll tell you the one thing you cannot do, and a lot of people do this, don't do this. Don't use a book cost of debt. You know what a book cost of debt is? You take interest expenses, you divide by the book value of debt, and you say, that's my book interest rate. It's nothing to do with the cost of debt because it reflects the type of debt you have. Short-term debt will be cheaper than long-term debt, and when you borrow the debt. So I'm going to lay out a very simple process for coming up with the cost of debt. And if you're in my corporate finance class, you probably remember this. I said, let's say you want a cost of debt for a company. It doesn't have a rating, it doesn't have bonds, but it has bank debt. You're saying, what do I do now? Think like a ratings agency. If I were attaching a rating to the company, what would I look at? And ratings agencies claim to look at everything. But the truth is, they narrow it down to about 7 ratios. In fact, if you go to the S&P website or the Moody's website, they list the ratios out. Interest coverage, EBITDA by fixed charges, debt to, basically they said these are the 8 ratios and they report them by ratings class. And even the 8 ratios probably overstate what they do, because it turns out that if you look at non-financial service companies, just non-financial service companies, half of all the differences in ratings for companies can be explained by one ratio. It's the interest coverage ratio. And if you've forgotten what the interest coverage ratio is, it's just the operating income divided by interest expense. The higher that number, the safer you are as a company. So let's take Embraer. In 2003, if you looked at that ratio, you divide the operating income, and because the operating income is volatile, I've used an average operating income, and divide by the interest expense, you come up with an interest coverage ratio of 3.56. So let's say I showed you that ratio, 3.56, and I said, is this good? Is that bad? And your reaction is, I have no idea, right? If I can somehow give you a table where you can take that ratio and convert it into a rating, you should be home free. You now have a synthetic rating. So about 25 years ago, I concocted this table based on actual rated companies. I'm basing it on companies that are rated. And this is the table that I could use for large companies or small companies, but I use 2 different sets of rules. If you're a large company and you have an interest coverage ratio of 3.56, if you look at the first column, the rating I would give you is A-. If you're a small company and you have an interest coverage ratio of 3.56, the rating I'd give you is BB+. You're saying that's not fair. Why are you penalizing me for being a large company? For being a small company, the world's not fair. Ratings agencies tend to treat larger companies better than smaller companies because they assume it will survive better. So the process is very simple. You give me your operating income and interest expense. I come up with the coverage ratio. I go to this table. I come up with the rating. In the last column, you see the default spread that goes to the rating. So if I give Embraer an A- rating because they're a big company, the default spread that goes with that rating is 1%. I'm home free. I take that default spread, add it to the T-bond rate. If I'm doing everything in US dollar terms, I have a cost of debt for Embraer. I'm going to add one more thing to it, but you can see that the process of coming up with a synthetic rating, that gives me the default spread. So the default spread I get is 1%, but there's one catch with Embraer. It's a Brazilian company. You're saying, so what? For better or worse, the fact that they're a Brazilian company is going to hurt them when they go out to borrow money. It's a risky country, banks are going to charge a higher rate. And I know a lot of people say, there are companies can evade it, but the reality is a Brazilian company will always end up paying a higher cost of debt than an otherwise equivalent US company, even if they're both multinationals. The default spread for Brazil in 2004 was 6%. It was a very risky country. Now, if I wanted to use the bludgeon approach, I can say, you know what? Embraer is a Brazilian company. In addition to paying the 1% default spread, which is company specific, they'll have to pay the extra 6%. But I gave them a little bit of wiggle room, and here's why. Embraer sells its aircraft in the US and Western Europe. It collects its revenues in US dollars and euros. You know why that's a benefit, right? When you borrow money, they're actually at an advantage in terms of paying off the debt. And in 2004, if you looked across Brazilian multinationals like Petrobras and Vale and Embraer, they were actually borrowing at a lower rate than the Brazilian government. They were able to escape from some country risk because of the fact that they had revenues in US dollars or euros. Now, the way I'm going to deal with that is I'm going to take the 6%, and this might sound arbitrarily, but rather than add the entire 6%, I'm going to say, look, given these other companies, and I looked at their bond yields, and the bond yields were about 2/3 what they were for the Brazilian government, I'm going to add only 4% out of the 6%, 2/3 of the 6% as my extra country default spread. So let's see where we are. I start with the risk-free rate in US dollars. Why? Because I'm doing my valuation in US dollars. To that, I add a company default spread of 1%. And on top of that, I add a country default spread of 4%. You add those numbers together, my pre-tax cost of debt for Embraer is 9.29% in US dollar terms. I have to keep reminding myself the currency because I can't get my currencies mixed up. Risk-free rate plus company default spread plus country default spread. Now, the synthetic rating tape, I'm sorry, go ahead.
I have a quick question, Professor.
Go
So
ahead.
why 2/3 for the company?
Well,
default?
because I actually looked at the bond yields because Vale had bonds outstanding, Petrobras had bonds outstanding. I could look at what they were paying as dollar rates. I could look at what the Brazilian government was paying. And at least in 2004, that's what it looked like. The percentage of the country risk that these companies were bearing was 2/3. Now, if you are a purely Brazilian company getting all your revenues in Brazil, in reais, my guess is you're bearing the entire 6%. You have no way to escape. So one of the escape hatches here is the more you can get your revenues outside the country, the less exposed you are. In fact, it's a reason the ratings agencies had to change their ways. Because until I think the middle of the last decade, you know what a company's rating could never, there was a limit called the sovereign rating ceiling. No company in a country was allowed to have a rating higher than the country. So if you were in Zambia, you could be the safest company on the face of, in all of Zambia, but they would still give you a cap. The argument was ratings agencies assumed you could never escape country risk. And I'm giving you a little bit of an escape hatch, but not a complete escape hatch.
Can we do a similar argument for oil companies as well? Because, for example, all these Saudi companies.
Absolutely. Yeah, and I think in a sense, oil companies will reflect the same thing, which is they sell into a global dollar market. The problem with Aramco is I don't know where Aramco stops and the Saudi Arabian government begins, right? It's not a typical oil company, but maybe the Nigerian oil company, you could argue, is safer than the Nigerian government, right? But I think you could make the same argument on cost of debt is only some of that risk shows up. I'm sorry, yeah. So a couple of things about this table, because I use it all over the world. I use it in Central America, I use it in Africa, you know, I use it all over the place. And people say, but that table came from looking at the US. You're right. You know why it came from looking at the US? Because at least at the time when I first started developing the table, the only part of the world where you had corporate bonds that were traded, that you can observe the yield, was the US, because the rest of the world was still on bank loans. Today, when I do this table, I draw on rated bonds around the world, but a big chunk of them are still in developed markets, the US and Europe. And I have no qualms about using these spreads in other markets, but here's the one thing you have to watch out for. These default spreads are dollar spreads or euro spreads. So they're built on a really low risk-free rate base. If I'm in a market with a 10, 12, or 15% risk-free rate, remember in Zambia, the Kwacha risk-free rate is 10.6%. I probably need to scale up my default spread. So the fact that I'm building, in other words, if my risk-free rate is 10.6%, there's no way I'm settling for just 1% more than that. Even if you're a safe company, I'd probably demand a higher spread. So that's the only qualifier I would add, is if you're in a very high risk-free rate environment, you might have to adjust these default spreads. It's not difficult to do because you just base the inflation difference. But I have no qualms about using this because really you have no choice. The markets where you can get default spreads tend to be developed markets, and I'm taking the table and applying it in other markets. And the default spreads themselves can change. Remember the table I showed you of equity risk premiums and how much they can change during a year or across time? The same thing applied to default spreads, the price of risk in the bond market. In 2008, during that crisis, when equity risk premiums kind of jumped all over the place, remember they went from 4.4% to 8%, default spreads for bonds also widened dramatically. No surprise there. If you're in a crisis, every market is going to reflect it. So across 2008, if you look at a triple B rated bond, it started the year at 2% and ended the year at almost 6%. Think about it. Your rating as a company could have been completely unchanged, but your cost of debt just jumped over the course of the year. Why? Because the market's in a crisis. This is one reason why I'm very wary of people taking cost of debt, leaving it as a fixed number over time, because the default spreads will change even if your rating doesn't change. And in January 2021, I looked at the default spreads. And this is again a testimonial to how different 2020 was as a crisis than every prior crisis. You know what happened to default spreads during 2020? I mean, if I told you nothing about the market and I told you about this COVID hitting the market in February and the global economy shutting down, and I told you you couldn't see markets there, what do you think would happen to the kinds of spreads you should be charging when you're lending to companies during a year like this one? I wager most of you would say, that sounds terrible. Companies are shutting down. That probably increases default risk. I should be charging higher spreads, right? And between February and March, that's exactly what happened. Default spreads tripled. A triple B rated bond saw its default spreads go up 300%. It went from 1.33%, almost 4%, March 23rd. And then you track these bonds for the rest of the year. Remember what happened at equity risk premium? They came back to where they were. That same thing seems to have happened to default spreads. Again, all you can see is observe and say, this is what it is. You can push back and say they should be higher because we're still in a crisis. That's a different judgment you can make about corporate bonds, but that's what default spreads look like right now. And one final point about the cost of debt. Sometimes you can have a company that is able to borrow money at a rate that is too low. You know what I mean by too low? Given its default risk, it could be borrowing at 9%, but it's able to borrow at 6%. And the reason is, the government has stepped in and subsidized the debt for good reasons or bad. What are the good reasons? A lot of green energy companies were given subsidized loans because the government had an incentive saying, we want green energy to take off. Tesla in its early days got subsidies on its borrowing. So let's make this specific. Let's suppose you're looking at Embraer. And because Embraer in 2004 was viewed as one of the crown jewels of the Brazilian government, the Brazilian government was lending it money at, let's say, 6% in dollar terms instead of the 9.29% they should be paying. Subsidized debt. So my question is a very practical one. When you do the cost of capital for Embraer, should you be incorporating the subsidized debt at 6% and lowering your cost of capital? Clearly, it's cheap debt. You're getting cheap debt. Or is there something which you could do that will allow you to reflect the true cost of debt and bring in the subsidy benefits? Because clearly there is a subsidy benefit separately. Let's take the first approach. Let's suppose we build in, Prithvi, I'm going to put you on the spot. You put in the 6.29% in 6% into the cost of debt calculation. That's going to lower your cost of capital. What are some of the consequences of bringing it into the cost of capital? What should you worry about? You made your cost of capital lower because you've subsidized debt. But what are some of the consequences that you might you should be careful with? What do you use this cost of capital for? To do a discounted cash flow valuation of the company, right? You lower the cost of capital, you're going to increase the value. But if you leave the cost of capital at that low number, what are you assuming about the subsidized debt? How long are you going to get that subsidized debt? You're assuming you're going to get the subsidized debt forever. And government subsidies don't last. Do you see what the problem is? Once you build something into your cost of capital, if you're not careful, you're going to lock it in forever. And if you lock it in forever, you might end up overvaluing the company because even the Tesla debt is now gone. Why? Because you're an $800 billion company. There's no way the government's standing there saying, would you like to borrow money at 3%? We'll lend you the money. Subsidies go away. And if you build in the cost of capital, it becomes much more difficult. There's a second thing to factor in, which is the government does nothing for free. When you get a subsidy from the government, do you think there's something that you need to do in return for that subsidy, trust me, there is always something, there is a price that's going to come to you. I'll give you an example. This is not on debt, but this is on price subsidies. I was valuing an Indian sugar cane company, it's a family-owned sugar company. In India for the long time, sugar prices were set by the government, so they were subsidized. They were given a higher price. But in return for setting the higher price, they had to sell a certain quantity of their sugar in ration shops at a very low price. So they were told, you can get the subsidy, but in return, you got to do this. 20% of your sugar has to be available to people who are poor at this really low price. And the company was doing it. So I was valuing the company, and when I put in the price, I actually put the market price in. But they said, no, we get a higher price than that. I said, I know. But I'm going to value first with the market price, and then I'm going to bring in both the costs and the benefits of the subsidy. The benefit of the subsidies, you get that higher price. The cost of the subsidies, that 20% of your product has to be sold at these way below market prices. And the value that I got with the subsidies built in was lower than the value that I got without the subsidies. And this is, what does this all mean? I said, you should probably go to the government and say, thank you, but no thank you. I can live without the subsidy. By separating the subsidy from your valuation, you can ask yourself, is this worth it for me? Is it actually increasing value? Because while it looks like it's a free lunch, as those traders in Robinhood discovered, there is no free lunch. You thought you were trading for free when in fact you were subsidizing money flows somewhere else. There's always a consequence. And in this case, you can see how much that consequence is. So my suggestion is, if you have subsidized debt, don't build into your cost of capital. Use the 9.29%. And then at the end of the valuation, you can capture the effect of the subsidy. It's very simple. What's the advantage of being able to borrow at 6% of 9.29%? It's 3.29% a year. Take that interest savings you're going to get, take the present value of the savings, you're done. That is the value of your subsidy as a separate line item. But by keeping it separate, you can decide how long the subsidy will last, and you can forcibly take it out of your valuation when it's done. So we've got a cost of equity from the risk-free rate, the beta, the risk premium. We've got the cost of debt based on an actual rating or a synthetic rating. Last step in the process is we need weights for debt and equity. You open up any finance textbook, including mine, you know what you're told, right? Use market value weights. As opposed to what? Book value weights. Any of you are on your path or have a CFA already? Any CFAs in this room? Prachi, you're a CFA? You're working your way? No?
Clear the exams, don't have the charter.
What level? 2, 3?
All three.
All three.
All three done.
Okay, so you're already almost pretty much done. Anybody on the way? I'm going to offer you a challenge. I'm going to ask you one. You know how Prachi can tell you, CFA exams are endurance tests, which is you're asked to read 7,500 pages, and then you're asked what was on page 4,355, and you can't answer the question, you're failed. Why? Because they have to fail like 60 to 70% of the people. And I've been giving the keynote for the CFA conference for 30 years, and I keep begging them. I don't have a CFA, but I say, will you let me write the exam 1 year? Because I think this is the wrong way to test people. They never let me give me a chance. But if they let me write an exam, I'd have only one question. And if you get this question right, I'll give you all 3 levels of the CFA. It's an unofficial CFA. You can call it CFA Demodern if you want. So you ready? I'm going to throw the question at you. We're taught to use market values for debt and equity. Why market value weights, not book value weights? And I'll give you some choices. Because the market is usually right. You know what's the problem with picking that choice? You undercut what you're trying to do. What are you trying to do? You're trying to value the company and tell me whether something is cheap or expensive. And if you start by saying market's usually right, what's left to argue, right? So that's not it. Is it because market values are easy to obtain? As opposed to what? Book value is right there in the balance sheet, right? Book value of equity, book value of debt. So that can't be it. Is it because you have supreme contempt for accountants, which I sometimes do, but that can't be the reason why you could use market. Markets make mistakes too. So it's none of those. So what do you think it is? What is the rationale for using market value weights for debt and equity, at least to get started in your cost of capital? I know we can move to target weights, but they're still supposed to be in market value terms. It's a rationale. Prachi, since you have all three CFA levels almost, do you want to tell me? Why do we use market value weights?
I think it's because you are trying to evaluate the cost of capital if you had to raise money today, be it via the equity or debt.
You already have three levels, or I'll give you an unofficial CFA on top. It is because you're estimating how much it would cost you to acquire the company today. Think about it. You have to go buy all the shares and you have to go buy all the debt. And you know what you'd have to pay for them? Not book value, but market value. You're saying, what if the market is wrong? It doesn't matter. You still have to pay the price. If you decide to do an acquisition of Tesla, you can't say my intrinsic value is $200 per share. I won't pay more than 200. You can try, but nobody will sell their shares to you. You have to pay the $750 or $700 or $800 per share. When we don't use market value weights because they're right. We use market value weights because that's what will cost us to buy the company today. It's because it creates this almost interesting disconnect, right? Because when you do cost of capital, you use market value weights. Then you value the company and you come up with intrinsic values that are actually different from the numbers you use to get the market value weight. So you're telling me at the start of the process that Tesla is worth 800. The end of the process, you're saying Tesla is really worth only 200. You're saying, how can you live with both numbers? The reason I explain the fact that I can live with both numbers is the first number is what I had to pay. The second number is what I think the company is worth today. So we use market value weights, not because we think markets are efficient or markets are right, because that's what it will cost us to do the acquisition. So I have everything I need for Embraer, and you're going to see everything we've talked about probably over the last 80 pages come together on this page. First, I'm going to value Embraer in US dollars. That's a choice I made up front because in 2004, I couldn't even get a nominal REI risk-free rate. So it wasn't even a choice, I said dollars. Where does that play out? My risk-free rate was the US T-bond rate, 4.29%. So that's where the 4.29% comes from. I needed a beta for Embraer. And if you remember, the way I got a beta was not by running a regression against the Bovespa or the S&P 500. I looked at the betas for global aerospace companies and adjusted for the leverage of Embraer. So that's a 1.07. I'm multiplying the 1.07 by 4%. That was my implied equity risk premium for the S&P 500. The S&P 500 in 2004. You say, but Embraer is not a developed market company. You're right. I'm going to bring in country risk. By estimating the equity risk premium, the country risk premium for Brazil, 7.89%, but then saying, look, Embraer is not a typical Brazilian company. It's far less exposed than other Brazilian companies. And now, what you remembered, I computed this lambda by running a regression of Embraer's stock price against the Brazilian government bond returns. So essentially to find how much country risk that was. Risk-free rate plus beta times mature market premium plus lambda times country risk premium. If I'm valuing Embraer today, I'm not even going to go down the lambda route because they have too many emerging markets they're exposed to. I'd probably just take a weighted average equity risk premium, multiplied by a beta and be done. But my cost of equity reflects my currency choice, the business I'm in, the aerospace business, and my country risk, 10.7%. For my pre-tax cost of debt, if you remember, I started with the same risk-free rate, 4.29%, added two default spreads, one for the company, one for the country, 9.29%. Now, of course, with debt, I get an advantage. Interest is tax deductible. And to capture that advantage, I look at the marginal tax rate. What's the marginal tax rate? The tax rate you pay on the last dollar of income. It's not an effective or an average tax rate, the marginal tax rate. The marginal tax rate for Brazil was 34%. And since Embraer has almost all of its debt in Brazil, I'm going to assume it gets that full tax benefit, 34%. So don't be fooled by effective tax rates of 11, 12. They have nothing to do with the cost of debt. Have an after-tax cost of debt. For the weights, I use market values. Market value of equity was easy. Share price times number of shares. I had to count all class of shares. So it's something to keep in mind. If you have 3 or 4 class of shares, bring them all in, not just the traded shares, but every share's got to bring in. That's my market cap. And for the debt, I used the market value of debt, and this required a little bit of a dance. And here's why. Much of Embraer's debt was bank debt. There was no market price for it. I couldn't go look up a market price. So I used a shortcut, which I've used in my corporate finance as well, which is rather than use the book debt and do hand waving saying, I can't estimate the market debt, I converted the book debt into market debt. Sounds fancy, but I acted like the entire book debt was a gigantic bond. And here were the characteristics. The interest expense of 222 million that Embraer was reporting was like a coupon. The 1,953 million that was a book value of debt was like a face value. And because they told me the debt had an average maturity of 4 years, I acted like I paid 222 million every year for the next 4 years, 1,953 at the end of the 4th year. And because I already had my cost of debt at 9.29%, I could discount those cash flows back to the present. Essentially, it's a simplistic way of converting book debt to market debt. It gives me 2,083 million. So I have 11.042 billion in equity, 2.08 billion in debt. That works out of about 84% equity, 16% debt. I end up with a cost of capital in US dollar terms of 9.97%. A lot of moving pieces. None of them individually is complicated. You just have to make sure that you don't miss a piece, because it's so easy to do. 6 pieces coming from 6 different places. This is my US dollar cost of capital in 2004. Let's say that you do this for your company. You're doing an Indonesian company. You come up with a rupiah cost of capital. Or let's say you decide to do the Indonesian company in dollars. And then at the last moment, you say, you know what, I'd rather do everything in rupiah. In the case of Embraer, let's say after I got the dollar cost of capital of 9.97%, I said, you know what, I wish I'd done everything in reais. You could start from scratch and build up, right? Start with a real risk-free rate and do everything that we did. And that's one way I tried it. Start with the real risk-free rate, build up to it. But I'll give you a better way of doing this, and it goes back to what we said about currencies. Why do rates vary across currencies? Because of differences in inflation. If your US dollar cost of capital is 9.97%, and let's for hypothetical purposes assume that the inflation rate in Brazil is 8%, the inflation rate in the US is 2%. So the real is 6% higher inflation. If you're in a hurry, here's all you can do. Take the 6% difference in inflation, add it to the 9.97%, you'll come up with roughly 15.97%. That can be your real cost of capital. The right way to do it, though, is because things compound here, is I take the 1 plus the 9.97% US dollar cost of capital, and I reflect the difference in inflation as a ratio rather than as a difference, 1.08 divided by 1.02. You do that, the US dollar cost of capital of 9.97% becomes a 16.44% nominal real cost of capital. This is a very good trick to have in your arsenal, because it means that you can do all this work in one currency, and you're presenting this to a client, a company, a manager, and the manager says, look, I'd rather you'd done this all in rupiah. You don't have to go back and start from scratch. All you need to do is bring in the differential inflation. You can go from currency to currency almost with, it's trivial if you can get the inflation rate difference. Any questions on the cost of capital? One final point, I mean, in my cost of capital calculation, there are only 2 ingredients, debt and equity. You're saying, what if I have other stuff on my balance sheet? What other stuff? We're talking about hybrids, convertible debt, preferred stock. Convertible debt is really part debt, part equity. You know which part is debt? The coupon, the face value, the maturity is a debt part. The conversion option is really equity. And companies can raise equity through either common stock or warrants. Think of a convertible bond as part equity, the option part, the rest is debt. So if you have convertible debt, here's the best thing to do. Split it into the 2 pieces. Take the convertible bond, act as if it has no conversion option, value it today. So if you're looking at a convertible bond issued by Embraer, value the bond using a 9.29% cost of debt. You're going to get this low number because it's a convertible debt with a low coupon. That is the debt part of your convertible debt. Whatever's left is the convert. You don't even have to use a Black-Scholes option pricing model. You just have to separate the conversion option from the debt. The conversion option becomes equity. The debt portion becomes debt. There goes that hybrid. Preferred stock, at least in the US, is a pain in the neck. I hate it. Preferred stock in Brazil is really common stock with different voting rights. I treat it like common stock, but preferred stock in the US is this strange hybrid, right? Because when you buy preferred stock, you get a fixed dividend. You're told what your dividend is going to be. It's like a coupon. So part of you says, let's count it as debt. In fact, many analysts do so, but it comes with a catch. The catch is preferred dividends are not tax deductible. It is very expensive debt from that perspective because you don't get a tax advantage. In fact, from a corporate finance standpoint, it's actually very difficult to justify the issuance of preferred stock. And if you think about the two groups of companies that are the biggest issuers of preferred stock, among mature companies, you know what sector issues the most preferred stock? Anybody have a guess? It's banks. Banks and financial service companies. You know why they like to issue preferred stock? Because some measures of regulatory capital count preferred stock like equity. So they do it to kind of do this regulatory loophole, which is we're going to borrow money, but we're going to call it preferred stock so that you can count it as part of regulatory. It's a stupid game to play. Because that preferred dividend now is to be paid in good times and bad times. You just loaded yourself up and you don't even get a tax benefit. The other group of companies that use preferred stock tend to be very young companies, and usually they issue convertible preferred stock. You know why they don't care about the tax issue? Because they're losing money anyway. Who cares? Whether you preferred dividends or interest, you're not going to get a tax deduction anyway. And venture capitalists like to have this cash flow claim to increase their bargaining power in case something goes wrong. And of course, it's convertible. If things go really well, you convert to equity. But if you have preferred stock and it's a big amount, then you really have to create it. I don't like to create a third source of capital because it makes my life messier. But if you have debt, equity, and preferred stock in enough quantity, then you've got to have debt and the cost of debt, equity and the cost of equity, and preferred stock gets its own weight. And the cost of preferred stock is just your preferred dividend yield. It's as simple as that. So it's basically, if your dividend is $5, the preferred stock is trading at 80, 5 divided by 80 is 6.25%. That is your cost of preferred stock. There's no tax advantage because you can't deduct it. So just to show you how convertible debt can be stripped to its basics. Let's say you're valuing a company. It has $125 million in face value of convertible debt. It's got a 4% coupon rate and a 10% maturity. So it looks like a traditional bond, right? There's a coupon, there's a maturity, and there's a face value. But it's convertible. And the convertible debt is trading at 140 million. So you're trying to break that 140 million into how much of it is debt and how much is conversion option. Now there are two pieces to it. You can either value the option using an option pricing model. You can value a bond using a bond pricing model. And my rule with option pricing models is never bring out the bazooka launcher to kill an ant. Why bring out all the variants and black shows when you can just value a bond? So here's what I'm going to do. I'm going to take the bond portion of the convertible debt and value it. And to do this, here's what I need. I first need the coupon, 4% of 125 million. Gives me 5 million as coupons. The face value is 125 million. I value it as if it were a straight bond. I act like the conversion option's gone away. And given that this company is a risky company that normally pay 8% on this bond, I discount the cash flows on the bond at 8%. Think of that as the current interest rate the bond would have to pay. What I get as a present value is 91.45 million. What does that tell me? If this bond had no conversion option on it with that coupon rate and that maturity, it'd be trading at 91.45 million. Which means that the rest of the 140 million, the 48.55 million that I have paying as a premium must be for the option. So I'm going to take the 48.55 million, put it into equity, take the 91.45, put it into debt. My convertible debt is off my books. So if you're unlucky enough to be looking at a company with a lot of convertible debt, play this game out. It'll get rid of the convertible debt. It'll make your cost of capital calculation a lot more straightforward. So we're at the end of the discount rate picture. Let's review where we are. Your cost of equity comes in the business you're in, risk-free rate, beta, and risk premium. Your cost of debt reflects your default risk as a company. The weights you attach are market value weights. And the tax benefit you compute will be based on your marginal tax rate. You bring those all together, you have an overall cost of funding the company, which reflects both debt and equity. And that becomes your discount rate if you're doing a discounted cash flow valuation of the entire company. If you're valuing just the equity, you can stay with the cost of equity. If you're valuing the entire business, this becomes your discount rate. Any questions about discount rates? Okay, that's the last you're going to hear me talk about discount rates. Let's put it away. Because as I said, we spend far too much time in valuation talking about discount rates and not enough time talking about cash flows. So I'm going to start the discussion of how we get cash flows. And I'm going to break it up into 3 parts. I'm going to start with earnings. Much as I like to dump on accountants, the starting point for every cash flow is a measure of accounting earnings. So that's net income or operating income. I'm going to start with the earnings, make sure my base earnings are a number I can build on. Is that, in fact, what the company earned? Second stop, I'm going to check to see how much of those earnings you're putting back into the business. As what? If you're a manufacturing company, how much are you putting back into new factories, new equipment? If you're a pharmaceutical company, how much are you putting back for future products in the form of R&D? If you're a consulting firm, how much are you plowing back to build up your human capital? So I've got earnings, I subtract out reinvestment, and you can have a dozen different line items in reinvestment. You can reinvest by building new plants. You can reinvest in R&D. You can reinvest by acquiring other companies. But generically, that's the second stop. And the third stop is if you ask me, what's a cash flow to equity? Then I compute what additional cash flows you have. How much do you have to pay out to debt, either as principal repayments or interest expenses? But by separating the 3 steps, I'm trying to narrow down on what is it that drives cash flows. One of the things you always have to be careful when people talk about DCFs is people act as if CF is CF. What's the big deal? But how you measure CF can make a big difference in your valuation. Broadly speaking, as we said, you can measure cash flows to the business or you can measure cash flows to equity. When you measure cash flows to equity, you can be lazy and look at what companies actually pay out, dividends and maybe add buybacks. Or you can do it yourself saying, I'm going to measure what they could have paid out by looking at the cash left over after I've met every conceivable need, interest payments, principal payments, CapEx. It's called free cash flow to equity, potential dividends. If you're looking at free cash flow of the firm, the big difference is you're looking at pre-debt cash flows. But take a look at free cash flow to equity and free cash flow of the firm. A good exercise, set them next to each other and see what they share in common and what's different. You see what the starting point is? When you do free cash flow to equity, you start with net income. Why? Because you care about equity investors. Net income measures income to equity investors. When you start free cash flow to the firm, you start with operating income. Why? Because you look at the income to both equity and investors and lenders. The starting point's different. What you subtract out as reinvestment is exactly the same in both cases. CapEx, depreciation, working capital, whatever you use, that reinvestment number is the same in both calculations. But free cash flow to equity calculations keep going. They have to subtract out debt you repay. And if you take on new debt, and this is a little counterintuitive, that's cash coming into the company. You can have free cash flow to equity that are higher because you borrowed money that year. That's cash accessible to you. But free cash flow to the firm versus free cash flow to equity, the starting point is the same. Now, I know if you've done DCFs, you have lots of line items that separate earnings from cash flows. So I'm going to put up some terminology so I don't confuse you as we go through, because you're going to see me kind of consolidate all these line items into a word. The normal way in which we compute free cash flow to the firm is we start with the after-tax operating income. And then we add depreciation, and we subtract CapEx, and we subtract change in working capital. That's a classic free cash flow to the firm calculation. You add depreciation, subtract CapEx, subtract change in working capital. If I consolidate CapEx, depreciation, working capital into one number, I'd call it reinvestment. So when I talk about reinvestment, I'm talking about reinvestment in everything that you would normally count in those individual line items. You've been looking at my valuation of the week, you'll notice I have no line item for depreciation, no line item for CapEx, no line item for change in working capital. But I have a line item for reinvestment. I compute based on how much your revenues, and that sales to invested capital, which I use, gives me reinvestment. And my point is that already captures all of them. Why would I waste my time breaking it down into pieces for a company like Airbnb, where I have no idea what future reinvestment is going to look like? And it's not just me, they have no idea how they will be reinvested. When in doubt, consolidate, and that's what reinvestment is. And if you prefer an even more compact form, if I took that reinvestment as a percentage of my after-tax operating income. So let's say I have 100 in operating income and I reinvest 40. 40 divided by 100, I get a percentage. That's called a reinvestment rate. What I'm trying to do is point out that when we talk about these terms, don't think of them as different things. They're just different ways of looking for the same thing, which is we're trying to figure out how much is this company putting back in order to grow in the future. But there's one loose end I want to tie up. The way we get after-tax operating income is a little strange. We start with the operating income, and we act like we pay taxes on that entire operating income. That's why it's often called an unlevered cash flow. Act like you have no debt. And that strikes people as unrealistic. If you have debt, don't you get tax savings? Why are you not counting the tax savings from debt? Does anybody want to try to address that question? When you do free cash flow of the firm, the cash flow definitely doesn't include the interest savings from debt, because it actually acts like you're taxing the entire operating income. Why are we so cavalier about ignoring the tax savings when we do the cash flows? Sergio, do you want to try?
Is it already included in our cost of debt?
In other words, we're going to discount those free cash flows. In fact, you can tell me where it's included, right? Where in the cost of capital was it included? It was, when I remember right, I multiplied by 1 minus the tax rate. I've already counted the tax savings from debt. You know what's going to happen if I include the tax savings in my cash flows as well? I'd be double counting. It's to prevent double counting that we act like you're going to be taxed on the entire operating income. So when people throw around words like unlevered cash flow, free cash flow, don't let them get away with it. Basically, nail the definitions down, because people are incredibly sloppy. Free cash flow is a word that should never be used without completion, because it could be free cash flow to the firm or free cash flow to equity. So what the heck does free cash flow even mean? So when people use things like EBITDA as free cash flow, don't let them get away with it. EBITDA is not a free, I don't even know what kind of cash flow it is. You stopped halfway, you got tired and said, that's my cash flow. What happens after that? No taxes, no CapEx, no working capital. I know you will come across as nitpicking, but if we're not careful about defining cash flow, all the rest of the hard work you do will kind of break down. So let's talk about earnings. You sit down to value a company. Let's face it, you have to start with financial statements. The reason I created that six-session accounting class, and if you get a chance, if you still kind of hazy in your accounting, try it out, was with an admission. Look, I said, look, I'm not an accountant. I don't like accounting, but whether I like it or not, my raw material comes from accountants. So you sit down, you open that financial statement, says, these are the earnings for the company. Before you use that number, though, there are 3 checks you want to run. First, you want to make sure this is the most updated value you can get for your company, right? If it's a 2019 annual report and you're sitting in 2021, you know you're already in trouble. Second, if you look across time, you'll see earnings go up and down. If you're a commodity company, there'll be good years, there'll be bad years. 2020 was an awful year. You might want to think about, do I want to normalize that number? Easier said than done, because normalization basically means looking across time and say, what would I make in a normal year? And God help you with an oil company. What exactly is a normal year going to look like from this point on? And third, you got to clean up after your accountants. We talked about how CapEx is defined much too narrowly in accounting. And there was another expense that until 2019, accountants routinely screwed up on. It's a financial expense that routinely got treated as an operating expense. And I want to be mysterious, it's leases. I made a big deal about this in corporate finance, and I'll make a big deal about it now. Even though accountants have finally come to their senses, When you enter into a long-term lease, I don't care what you call it, it is like borrowing money. Why? Because you've contractually agreed to make those payments in the future. So I'm going to update, I'm going to normalize, I'm going to clean up to make sure that those things don't seep through. So let's start with the first of these things. How do you update earnings? As I said, the easiest way to do it is use trailing 12-month numbers. To do trailing 12-month numbers, you need your company to have full quarterly reports. In the US, that's standard. So trailing 12-month numbers in the US is almost trivial, right? You just pull up 4 quarters, add them up, you got trailing 12-month numbers. In fact, most data service in the US report the trailing 12-month numbers. You go to Capital IQ, you go to Yahoo Finance, they'll give you the last 10K, but they'll also give you the trailing 12-month numbers. So this isn't rocket science. You just take the last 4 quarters and add them up. But there are parts of the world where companies will have quarterly reports, but they're partial. They'll tell you revenues and operating income, but they won't give you the rest of the details. There, it's more difficult because some numbers can be updated and other numbers cannot. Even in the US, there are some footnotes on tables where you get only in annual reports. So employee options, for instance, will be in the 10K, but the 10Q might not tell you how many options are outstanding. Here's my suggestion. Don't be a slave to consistency and say, look, if I cannot get everything at the same point in time, I'm going to go back to 2019. Update what you can, normalize what you can, and keep moving forward. So you want to get the most updated numbers you can. You're saying, how much of a difference can it make? I mean, come on, after 2020, would you even ask that question? I mean, there's a big difference between using 2019 as your starting year and 2020 as your starting year. That's for mature companies. For young companies, it can make a lifetime of difference. 12 months can triple your revenues and your losses and make you a very different company. That's the first stop. Here's the second stop, and here's where things are going to get a little tricky. It is true accounting isn't consistent. It's inconsistent on both treating things like leases as operating expenses when in fact they're financial expenses, and treating things like R&D as operating expenses when in fact they're capital expenses. You're saying, who cares what kind of expense? It's an expense anyway. It changes the measured earnings for a company, what you see as book value. It affects everything you see in the company's financial statements. So I'm going to start with leases, even though accountants have got their act together finally on leases, at least for the most part, and talk a little bit about why this is always a big issue. In some sectors, you might not care about leases, but in some sectors, this is the way companies borrow money. Traditional brick and mortar retailers. No, the Gap never owned a single store physically. Even the original store where they started from was leased. Every single store the Gap had was leased. And at the height of their glory, these stores were in malls, 10 to 12-year leases. And if you look at the Gap's balance sheet, you saw very little debt because none of it was treated as debt. They were treated as operating leases. But the Gap did have to reveal lease commitments. Basically, they said, these are the contractual commitments we've agreed to pay for the next 10 years. There's no argument that this is debt and should have always been treated as debt. In fact, accountants have known this since 1949. Probably knew it even before that. 1949, I found a panel discussion at NYU. It was an accounting panel discussion on how leases should be treated as debt. 2019, they finally did something about it. So I'm going to take you through the process of capitalizing leases, even though accountants do it, because I want you to see where these numbers come from and how companies are going to start to play games to escape the accounting of leases. To convert leases to debt, here's what I'm going to do. I'm going to take your lease commitments, which you give me in a footnote, and I'm going to take each commitment and discount it back to today using the pre-tax cost of debt as my discount rate. The pre-tax cost of debt is the rate at which you can borrow money long-term today. You're saying, why the pre-tax cost of debt? Because the commitments you have in the table are pre-tax payments. So basically, I'm being consistent. When I take the present value of those lease commitments over time and I get a present value today, that becomes the debt value of leases. I'm going to put it on my balance sheet as debt. Let's call it lease debt. $3 billion. Well, my balance sheet has this very unpleasant requirement, which is it has to balance. So if I put a $3 billion lease debt, then I've got to create a $3 billion leased asset. Otherwise, my balance sheet will not balance. Now, when I create an asset, what am I required to do in the following time periods? I have to depreciate or amortize that asset. This is why you can't just open the door and tiptoe, and you got to go all the way in. If you're going to treat leases as debt, not only will your debt change because you brought the lease debt on, but your earnings have to get restated. Why? Because now you're going to add back the lease expense, saying I should never have subtracted it out. It's not an operating expense, but you're going to have to subtract out the depreciation you would have on the leased asset that will be on your books. In fact, if you want a shortcut, one of the shortcuts you can use if you're in a hurry is you can take whatever your operating income is, and because it's earnings before interest and taxes, add back the interest expense you'd have had on what you call lease debt. You're now going to get a different measure of earnings. Now, I did this at the Gap in 2003. This was when accountants weren't even talking about leasing debt yet, but the Gap was worried that this was coming. So they asked me to come in and talk to their top management on what this would do to their numbers. And I'll tell you up front that they went through various stages of delirium as I presented the numbers. Because initially they were very happy, and by the end of the process, they were completely bemused about what this would do. So I said, let me start with how I would do this. I said, I'm going to take your lease commitments, and in 2003, here's what they look like, $899 million. So this is one of the footnotes that companies used to report, is lease commitments in year 1, year 2, year 3, year 4, year 5. And US companies beyond year 5 just have to give a lump sum. They don't have to break it out. So this is what it looked like. They said they gave a lump sum of 1,000 something, 1,900 and something million. I took the lease commitments for the next 5 years, took that lump sum and broke it out to 2 years. Why 2 years? If you look at the amount of the commitment, it looked like roughly a 2-year commitment. So I have 7 years of lease commitments. And the pre-tax cost of debt for the Gap then was about 6% based on their rating. I discounted the lease commitments back to today using a 6% cost of debt. What I got as a present value was $4.4 billion. Just to give you some perspective, what the Gap was reporting in the balance sheet in terms of conventional debt was only $1.97 billion. But their lease debt was $4.4 billion. So here's the first thing that's going to change. When I do my cost of capital for the Gap, I'm going to have $6.3 billion in debt, not the $1.97 billion, because I'm treating the lease debt as debt. Now, in terms of operating income, here's what I did. I took the stated operating income for the Gap, which is $1.012 billion. And then I said, you know what? I should never have subtracted out the lease expense. So I subtracted out I added back the lease expense for that year and subtracted out the depreciation. I came up with a much higher operating income. Why? Because I'm now treating operating leases as a financial expense, not an operating expense. So let's see where we are. Debt's gone up, operating income has gone up. So here's the table I showed the Gap. I said, let me start with the good news. Right now, accountants tell me you make up $1.012 billion, but I really think you make closer to $1.4 billion. And they were very happy. They said, this is good, higher earnings, right? And I said, yes, you're going to get higher earnings. When you capitalize leases, your operating income will go up. Not your net income, because that's after financial expenses, but your operating income will go up because I moved an operating expense to a financial expense. They all started patting each other on the back and said, this is good, we should try to capitalize leases. I said, well, there are a couple of bad news items I have to give you. First, if you go to your balance sheet right now, I see only $1.97 billion in debt. But if I capitalize leases, that's going to be closer to $6.4 billion. And that made them slow down a little bit, because now they said maybe people will be worried about how much we borrow because they know the truth. And then I said, I have some good news now. So bad news, good news, bad news, good news. And I said, well, the good news is right now when I compute your cost of capital, if I trust the accountants, it doesn't look like you have much in debt. Your cost of capital is 7.31% because you have only $1.97 billion in debt. But if I treat leases as debt, something magical happens. Your cost of capital decreases because you're using a lot more debt than I taught you. So at this stage, they were ready to hit the ceiling. Higher earnings, lower cost of capital. This is all coming roses. And I said, here's the final piece of the puzzle. When you look at a company, one of the things you look at is whether they're beating their cost of capital. What kind of return are you making on your investments, and does it beat your cost of capital? And if I trust the accountants, they don't have much capital invested because the book debt is only 1.97 billion. Pre-adjustment, their return on capital was 12.9%, which means it looked like they were making almost 5.59% more than their cost of capital. But I said, if I capitalize leases, your return on capital is going to be lower because now I'm going to bring in this lease debt into the balance sheet as part of your invested capital. The return on capital you'll earn is 9.3%, which means you're still earning more than your cost of capital, but it's now down to 3%. You say, what does this all mean in terms of value? I said, we can value the company with it. And I think one simple measure of how much your value will change and in which direction is how much that spread between return on capital and cost of capital changes when you capitalize leases. Because what we're trying to do is capture the truth. Are you really earning more than your cost of capital? Because if you're growing and not earning your cost of capital, it is destroying value. This gives me a much clearer sense of, hey, what are you truly making on those stores you're opening in malls? There's a period about 6 or 7 years ago where Starbucks discovered it was opening too many stores. And we knew this. If you lived in New York, all you needed to get Wi-Fi was just point your phone and there was a Starbucks within a block of you, no matter where you were, like 6 Starbucks, And the way they found out was when they started capitalizing leases, because until they capitalized leases, it looked like they were making 20% returns in their stores. But once they capitalized the fact that that Broadway store you walk by every day costs you $1 million every 3 months or 2 months, and you very quickly start to realize your returns on capital on these stores was in the single digits, barely making your cost of capital. And they actually pulled back from the brink, thank God for that. But this is basically to give companies a better sense of what they're making and to give investors a better sense of what they're making. And that's why we capitalize leases, not because we're nitpicking accounting, but to get a better sense of what are you truly investing in this business? What are you making on this business? What's your true cost of capital? Now, until 2019, you'd have had to do this yourself. It wasn't rocket science, right? Take leases, take the present value, so it's built into every one of my spreadsheets. So it asks you, do you want to capitalize leases? You say yes, you go in and enter the commitments. I do it for you. So it's like happening in the background. Today, though, both IFRS and GAAP have changed their mind on leases. It is now treated as debt. So when you open up the GAP's balance sheet today or Starbucks balance sheet today, you will actually see a lease debt item. And accountants like to act all mysterious about how they get it. They do exactly what I just described. Take the present value of lease commitments and treat it as debt. So there's nothing that they're doing special. And one of the things I've been tracking for the last 2 years is while accountants have been reporting lease debt, they're also reporting the lease commitments. I'm doing what I've always done for 30 years on lease commitments converted debt, because I want to see how close I'm getting to the accounting numbers. In 2020, for the US, I was pretty close. I was with, my lease debt was about 15% higher than the accounting debt, but it was only 15%. In some parts of the world, the difference is much wider because accounting, as it always does, written all these discretionary clauses. If you have an operating lease with a contingency, we won't treat it as debt. And you know what companies are doing? They're starting to play games to make the lease debt not show up. So I will continue to convert leases to debt. But if I do that, I have to replace the debt on the balance sheet that the accountants are reporting with my lease debt. I can't count both. That'd be double counting. But just for your own sanity, try it out yourself, even if you decide to use the accounting debt. And then you can always change the yes to no, in which case I'll go back and use the accounting debt. But this is, I think, part of a broader issue, which is anytime a company enters into a contractual commitment over many years, it is equivalent to borrowing money. That's what makes operating leases debt. And it extends beyond leases. If you take Netflix and you look at their footnotes, one of the commitments they report are what are called content commitments. You know what those are? These are the contractual commitments that Netflix has entered into for the Seinfeld show or The Office or whatever else they've signed for the next 5 years. They're contractual commitments. They're effectively debt. Netflix has a lot more debt than you think it does. It changes your perspective of the company. I'm not saying it's going to be worse, it's just different. Any questions on lease debt and contractual commitments?
I have a question.
Matthew. Yeah.
When normalizing statements, so if you're looking back, say 5 years, and these financials have, I guess the new rules came into place in 2019.
It's
How
going
do
to
you,
make things, yeah, it's going to be very, unless you want to go back and do this in the previous years, that's one choice. You know, the easier choices, take lease debt out. Act like the accountants never came to their senses. But you're right, it does make it also makes things like multiples that people, remember how people use multiples often as rules of thumb? Many of the rules of thumb that were developed in retailing and restaurants might need to be revisited because they use the wrong definitions of debt. But people over time have learned to kind of do shortcuts to get around it because they've always recognized the problem. In fact, many research analysts with these companies didn't do the accounting thing of treat these leases as operating expenses. They actually converted them to debt using a shortcut. Multiply by 8. Multiply by what by 8? You tell me what your lease commitments are in year 1. I'm going to multiply by 8 and act like that is your debt. Why 8? Because 30 or 40 years ago, that's what lease time periods used to translate into in terms of present value. So somebody probably did it once and said, hey, you know what? It's too much work. Let's use 8 times lease. So analysts have always had their ways of dealing with it. But I think it does make cross-time comparisons difficult. It also makes it more difficult to use rules of thumb that were developed more than 2 or 3 or 4 years ago in sectors with substantial debt. Let's at least set up, I know we're getting to the close, R&D. So clearly, again, just like leases, not all sectors are equally exposed to it. It's a bigger problem in some sectors than others. Obviously, you know, with pharmaceuticals, it's a big issue. Technology, it's a big issue. But oil companies, you're saying, what R&D? You won't see an R&D expense, but you see an analogous expense that has the same issue. You know what the expense is for an oil company? What's the equivalent of an R&D expense? An expense designed to create benefits over many years that's treated as an operating expense.
Exploration.
Exploration costs, right? Because exploration costs show up as an operating expense when in fact they're really. So this is a problem that goes beyond R&D. So about 10 years ago, I was asked to give a keynote to the AICPA conference. It was in Vegas. Now I show up, there are 1,000 accountants. Vegas rooms are huge. There are like 1,000 accountants in a room. And this is as close to my vision of hell as you can get, being trapped with 1,000 accountants in a Vegas room. And I have the presentation I gave them because I don't think they're going to invite me back. I said, the title of the presentation was 10 Things in Accounting I Don't Understand. And this is one of the things I brought up. I said, you guys keep telling us that capital expenditures are expenditures designed to create benefits over many years. What the heck is your reason for treating R&D, which is really the ultimate CapEx, as an operating expense? What do you think the reason they gave for doing what they do with R&D is? If any of you have accounting backgrounds, you probably can guess. Kushal, what do you think the reason was?
That's how it's always done.
That's one of it, but accountants also try to make it look like it's more reasoned. Think like an accountant. I know it'll drive you crazy if you do it too long, but give yourself that moment. Anybody?
it's more conservative of an assumption?
That was the second reason. And it's conservative in what sense? It lowers earnings. Lower earnings is more conservative than higher earnings. And there was a third reason they gave, which is R&D is too uncertain. The benefits from R&D are too uncertain. Therefore, we cannot treat it as capital expense. To which my response was, if I built a factory in Kazakhstan, would he let me expense it? Borat could come and burn it down tomorrow. A lot of uncertainty. You don't let me do this uncertainty dividing line with a manufacturing plant. How come just with R&D you draw on this uncertainty card? So let's get this clear out. There is no good reason. This conservative thing cuts in both ways. It is true by expensing R&D, you lower your income. That's conservative. But by expensing R&D, you also take your biggest assets off the book. So when I compute the return on equity or return on invested capital for a technology company, I'm going to come up with a sky-high number, even though you might be making fairly average returns, because I'm not counting your biggest assets as part of the balance sheet. It is not conservative. It doesn't make sense. She's saying, why aren't accountants doing the right thing? mean, remember, it took 70 years for them to recognize that leases were a problem to actually do something about it. What makes you think they're going to fix R&D tomorrow? So we got to do it ourselves. Again, not a big deal, because here's the 3-step process to convert R&D from an operating to a capital. I'm not suggesting each step is easy, but each step has to be gone through. First step, on average, how long does it take between the time you do R&D and a commercial product emerges from it, on average? Notice I threw the on average because I know some R&D doesn't pay off. Some might pay off in 6 years, 8 years. Think about the answer to the question. A pharmaceutical company, if you're lucky, maybe 9, 10 years. In a technology company, maybe 2 to 3 years. And in some consumer product companies, it might be instantaneous. Second step, if you tell me it takes 5 years for R&D to pay off, I'm going to ask you for R&D expenses for the last 5 years. Last 5 years. Say, why are you looking backwards? Because if I decide to capitalize R&D, I've got to act like I've been doing it all the way through, not just right now. And if R&D has a 5-year life, what's a logical thing to do with that expense? Think like an accountant. Just spread it out across 5 years. So I'm going to take the R&D expenses from 5 years ago, write out 1/5 every year. 4 years ago, write it off 1/5. And I'm going to keep track of 2 things. One is how much of past R&D expenses I'm writing off this year. That's like an amortization this year. And how much has been left untouched by amortization. That becomes something I'm going to carry to my balance sheet. So I'll give you an example and we'll end with, oh, I'm sorry, we're beyond time. When we start next session, we'll start with an example of how to capitalize R&D and again, expand the discussion to other items like R&D, like advertising, like customer acquisition costs. Because a lot of technology companies are adding back these expenses and saying, you know what, they're not operating expenses. And I think that's a very sloppy way of dealing with this. But we'll talk about those kinds of expenses. I will see you on Monday.
Professor?
Yes.
Does the quiz include next Monday's lecture, or it's fine if I can take it tomorrow or Sunday and it's all
You can't
covered?
take it tomorrow and Sunday. It's not accessible till next Wednesday.
Oh, it's inaccessible to question. But I'm saying, and for studying also, it does include next lecture?
I would say through Monday, but we've covered almost most of. There might be the first 15 minutes of Monday, the last parts of cash flows, but I think it'll be through cash flows, wherever that takes us on Monday. Because on Monday we'll be finishing cash flows and going to growth. There'll be no growth on the quiz. It'll just be through cash flows.
Thank you very much.
I'll send you the slide number that it's going to go through. But it's discount rates, cash flows, all the things we did to lead up to intrinsic valuation.
Thank you.
Okay.
Thank you, Professor.
Take care. I will see you on Monday.